So let's go to problem 1, section 1. On October 1st of 2020, ACCRUED company takes out a $10,000 loan and agrees to pay interest twice each year for the life of the loan. $300 on April 1st after 6 months, and $300 again 6 months later on October 1st. How much interest expense will ACCRUED report on its income statement for the year ended December 31st of 2020 if it's on cash basis? Because it's on cash basis, technically no interest will be recognized because it's not paid yet. Under cash basis, you have no interest to recognize because nothing is paid yet. On the cash basis, you don't also recognize revenue until you get paid. However, under accrual basis, if your company is an accrual basis company who's doing accounting accrual basis and you report that to the IRS, and also you're following GAAP, which GAAP accepts accrual basis, then by end of the year, you have to think that, okay, October, November, December, 3 months has been accrued interest that you need to recognize. So $150 is the accrued interest for 3 months. Because 6 months is $300. So if you divide that 6 months by 300 by 6 months, that gives you $50 a month. And $50 a month times 3 months, it's $150. So on December 31st, you recognize interest expense for $150. That's a debit. Expense will increase. And interest payable will be recognized. That's a credit. And liability will increase. However, in April 1st, you need to pay this, right? So you're going to write a check for $300 to pay the first 6 months interest. But already you recognize an interest payable here, remember? So you're going to close that interest payable by doing a debit. And also for January, February, March, you're going to recognize interest expense for 3 months. So interest expense for 3 months in the new year and interest payable of the last year will be closed and the check will be sent to the lender for $300. Questions, please? Anyone? No? That's why I'm here. Okay. Let's do number 2. Near the end of the 2020, J&T Enterprises complete services for a customer and sends an invoice to that customer for $500. So job is done, invoice is sent. As of J&T's year end, no payment has been received. If J&T reports 2020's revenue of $500, it must be using accrual basis of accounting, right? Because if you provide the service and you recognize the revenue and send an invoice and you recognize accounts receivable for that, that means it's an accrual basis of accounting. Under cash basis of accounting, that's not true because under cash basis, you never recognize revenue until you get paid. On December 2nd of 2021, P&T pays $1,000 to an exterminator for work that will start in January. If P&T reports on its income statement $1,000 for exterminating expense for 2021, it must be using cash basis of accounting, right? Because on the cash basis, as soon as you pay for something, it's an expense. So small companies, they might use a cash basis of accounting, and that's normally what they do. And therefore, they recognize the expense since it's paid already. Under accrual basis, it will be prepaid maintenance, debit, cash, credit. Under cash basis, the journal entry will be debit maintenance expense, credit cash. Questions on number 2 or 3? No? It's okay. Don't be shy. Okay. Number 4. For each of the following unrelated scenarios, show how much revenue is reported on the income statement for 2020 under the cash basis versus accrual basis. On November 1st of 2020, Alexi Corporation receives $1,800 in rental payments for November, December, and January, $600 per month. Under cash basis, you have revenue, right? Right away. You get cash, God bless America, revenue is recognized. That's cash basis. However, under accrual basis, you will have only 2 months to recognize by end of the year. And that will be only $1,200 of revenue. And that's why accrual basis provides you a better picture, because under cash basis, you tell everyone I have $1,800 revenue, but under accrual basis, you are more realistic. And you say, you know, I have just 2 months of revenue, not 3 months. M&M caters 6 launches in December of 2020. M&M, each of these 6 customers is invoiced for $100. So they send an invoice. But the December 31st, 2020, only one has paid. Okay, under cash basis, only one is paid, so you have only $100 of revenue. But in reality, under accrual basis, you already provided 6 launches. Job is done. So job is done, revenue has to be recognized. So in this scenario, under accrual basis, you have $600 of revenue, T account. You have $100 cash in the cash T account, and you have $500 accounts receivable in the T account. Because the $500 is not paid yet, so it's receivable. And musician accept $200 for each 8 upcoming weddings. $200 for each 8 upcoming weddings. As of December 31st, 2020, the musicians has performed at 2 of the 8. So $200 for 8 events. 2 of them is performed already. So under accrual basis, you have only 2 events that has been earned, and that is your revenue, right? Just $400. But under a cash basis, again, God bless America. You got cash, you say, I have revenue, and you put that in your income statement, that you have revenue of $1,600. Make sense? Okay, no questions? Okay. For number 5, for each of the following unrelated scenarios, show the total expense reported on the income statement for 2020 under cash or accrual basis. In December of 2020, BICO runs ad costing $30,000. BICO receives the invoice, but does not pay it until January of next year. So since it's not paid yet, there is no expense. But under accrual basis, because the ads are already completed and you have the obligation to pay, so you have advertisement expense of $30,000 to recognize. That's debit advertisement expense, credit accounts payable. And that's how you recognize the accrual of the expense that has not been paid yet. On December 1st of 2020, KPT pays $2,400 for the next 12 months property insurance. So, so cash is paid under cash basis. Because cash is paid, everything is an expense. But under accrual basis, cash is paid, yes, but that was in December, and just 1 month of December is expired on until end of the year. So you have to recognize that 2,400 divided by 12 months insurance, that's $200 times 1 month expired. So policy has been expired just for 1 month, and that's $200 of expense that you need to recognize. This is just the math part, that understanding how much of expense needs to be recognized. In December of 2020, Andres pays $400 to pest control for 4 months service. December pays $400 for 4 months. The first treatment will be in January. So by end of the year, nothing is done whatsoever. But because it's cash basis, everything will be expense. So you debit maintenance expense $400, you credit cash $400. But under accrual basis, because nothing is provided yet, so you didn't get any benefit from this or service or goods, so you're gonna just show that you paid for it. So it's gonna be debit, prepaid maintenance, $400, credit cash, $400, and that will be it. So you will have zero expense. Okay. Let's go to section 2. So in section 2 of your book says, of course, you have to study it. There is problems and quizzes with the solutions given to you, but it's now time to do homework, assuming you did all those. Yeah, accepts, that means yeah, accepts the money, right? Sometimes people don't accept money at the front. They say, pay me after I'm done. But some people say, no, I like to get paid right at the beginning before I start anything. So that's number 1, section 2 says, select the terms on the right that best completes the statement on the left. Terms may be once used, more than once, or not at all. Okay, so failing to make the entry to accrue revenue. If you fail to make entry, journal entry, to accrue revenue, that is understating net income. If you don't accrue revenue, your revenue will be low, understated. If revenue is understated, that means net income is understated. Make sense? The first one? Any question on the first one, please? The entry to record accrued revenue, A, increases asset. That's true, because when you accrue a revenue, what are you doing technically? You are doing debit accounts receivable, credit revenue. Debiting accounts receivable, it is increasing assets. Accrued revenue is revenue that is earned but not collected. So if a revenue is accrued, that means it's earned. It happened already. It's completed already. But it's not collected until you send an invoice. You recognize that, which is debit accounts receivable, credit revenue. So revenue is recognized. You have accounts receivable. You will collect it one day, but for now it's just accrued. Failing to make the entry to accrue revenue understates asset. Yes, if you fail to recognize accrued revenue, then you're not gonna debit accounts receivable, credit revenue. You're not gonna do that. If you don't do that, then accounts receivable will not increase. If accounts receivable is not increasing, that means your asset is not increasing, and that means your asset is understated. The entry to record accrued revenue, A, increases the net income. Yes, if you record accrued revenue, you debit accounts receivable and you credit revenue. That means revenue will increase. If revenue increases, that means net income increases. Question on number 1, section 2. Okay. Let's go to problem 2. Kurtz Rentals rents equipment to Ditka on February 1st. Lease terms require Ditka to make payment to Kurtz of $2,000 each quarter, April 30th, July 31st, October 31st, and January 31st, each quarter. Kurtz receives payment for April, July, and October. So far, so good, right? What's the journal entry should Kurtz record on December 31st? So you got paid until October 31st. But November and December is accrued already, but you didn't get paid because you're going to get paid in January, right? So 2 months is accrued, but is not paid yet. So you have to say, okay, $2,000 times 2 divided by 3, 2 months out of 3 months, that's $1,333. So I'm going to recognize on December 31st that I have rent receivable of $1,333, which is accrued, and rent revenue will be credited. So rent receivable asset will increase, and the rent revenue will increase. Okay. Now I added this part myself. I said on January 31st, if you receive your rent payment, what would be your journal entry? On January 31st, your journal entry would be recognition of the payment you received, which is $2,000. Closing the rent receivable that you already recognized on December 31st, which is $1,333, closing that. And then you recognize that you also have a rent revenue for $667. If this entry is not recorded, this entry, if it's not recorded, how will it affect Kurt's financial statements? So if you don't record this receivable in the balance sheet, your asset will be understated. Okay? If you don't recognize this revenue in the income statement, your revenue will be understated. If revenue is understated, that means net income will be understated. And if net income is understated, then your retained earning in the equity will be also understated. So just to see that, maybe it's a good idea if I show you once so you can refer to this every single time we are going to talk about this. And we're going to talk about this a lot. So if you don't recognize that rent revenue, your net income will be understated. And why is that? So let me show you. This is your accounting equation, which is asset equals liability plus equity, right? Remember that? Asset equals liability plus equity, right? So if you don't recognize your accounts receivable of 1333, then your asset will be understated, right? But if you do, your asset will be okay. If you recognize this correctly, your equity has what? In a corporation, your equity is common stock, right? Minus dividend plus revenue minus expense, right? Makes sense? If I recognize my accounts receivable, asset will increase, but what will increase on the other side of the equation? The revenue will increase, which is 1333. So if the revenue is increasing by 1333, what is the result of revenue minus expense? Net income. So if your revenue is increasing, that means eventually your net income is increasing, right? And if net income is increasing, where the net income will end up? Net income will end up beginning retained earning plus net income minus dividend equals end retained earning. So what does it mean? That means if your revenue is recognized, your net income will be higher. If the net income is higher, then your end retained earning will be higher too. So because 1333 will be here higher, net income will be higher. If net income is higher, then the whole retained earning will be higher. So what you have in a corporation in the equity at the minimum? Two things, common stock and retained earning. So in a corporation, you have two things, common stock and retained earnings, right? Common stock is the stock that you issue to raise capital for your corporation. And retained earning is the remaining profit that you have for your corporation at the end of the year that you don't know what to do yet, but you can decide what you want to do with that remaining profit. We call it retained earning. The retained earning at the beginning, it's zero for any corporation. If it's a brand new corporation, retained earning is zero. But at the end of first year, you add the net income, you deduct any dividend that has been declared to shareholders. That gives you the end retained earning. So at the end, you have common stock and retained earning. in the equity, common stock and retained earning in the equity. And I want you to understand the differences here, because every time we're gonna look at this and we're gonna say, okay, if we do this, what will be the result in the retained earning? What would be the result in the asset? Or what would be the result in the liability? Remember, the net income is in the income statement, but asset, liability, and equity is showing in the balance sheet. So if you understate your your revenue, you will understate your net income. If you understate your net income, eventually in the balance sheet, the retained earning will be understated. Also in the balance sheet, the accounts receivable, which is asset, your asset will be understated. So if you make a mistake and you don't recognize something correctly, you not only will affect the balance sheet, but you also affect the income statement. So the whole financial statement will be useless. Make sense? That's why everyone can make a mistake, but accountant never have any chance to make a mistake. They have to be good. Otherwise, everything will be just junk. Okay, so we did this part, and we did that part too. Yeah, so we covered that number 2. Let's do number 3. For number 3, it says the company agreement calls for Intel to receive. So Intel is a technology company, and they have an agreement. So the Intel can receive $3 for each unit manufactured with licensing fees remitted quarterly. So they have to receive $3 for each unit, and they have to get that quarterly basis. As of December 31st, Intel has received the following payments. The production with the manufacturer was 475 units, and they got fees for it, times 3, 475 times 3. They got the second quarter, they got the third quarter, right? But let's read it. Intel has received checks for the first 2 quarters. Okay, the first 2 quarters, you see, those 2 are paid. But the third and fourth check is not due until January. So the third and fourth quarter, the payment is due. They didn't receive the third one, which is kind of weird because they have to receive it quarterly basis. The fourth quarter check is not due until January 1st. So that's good. But where is the third quarter? They didn't receive that. If Intel is on the accrual basis, what adjusting entry should it record at year end to recognize revenue earned from this manufacturing company? So they were supposed to receive this, and also fourth quarter is also due within next month, January. So they have 2 quarters to recognize, even though they didn't receive anything yet. Okay, so if you combine those, that will be licensing fee receivable, or you can call it accounts receivable. Either way is fine. 3,375 debit to increase the asset, and you recognize credit for the revenue of 3,375. So revenue will increase. Under accrual method, revenue is recognized in the year earned, right? So therefore, revenue should be recognized for 3,375. If it's not recorded that way, what would happen? So if you don't record this, the accounts receivable will be understated in your balance sheet. That means your asset will be understated in your balance sheet. if you don't record the revenue, then your revenue will be understated. That means net income will be understated. And if the net income in the income statement is understated, then the retained earning eventually in the balance sheet will be also understated. Make sense? So if I show you the camera one more time. Right? If your asset, which is accounts receivable, is not recorded, then your asset will be understated. Right? Accounts receivable, if it's not recorded, asset will be understated. In the equity, we have capital, right? Plus retained earning. Retained earning is revenue minus expense, right? Which is net income minus dividend. This is net income. So if accounts receivable is not recorded, that means asset will be understated. If asset is understated, that means revenue is understated. If revenue is understated, that means net income is understated. If net income is understated, that means retained earning is understated. Make sense? So if you understate your asset and you don't recognize the revenue, your asset will be understated. On the other side, revenue will be understated. Then your net income will be understated. And then because net income is understated, eventually in the balance sheet, retained earning will be understated. For example, here we say 3,300. How much was that in that problem? 3,375. So if $3,375 of accounts receivable is understated, then net income is understated by 3,375 because revenue is understated. That means net income is understated. So if this is understated, that means your retained earning is understated by 3,375. So as you see, you can say, yes, my equation is equal because this side is understated and that side is understated. But the information in your financial statements is wrong. Yes, it is still equal, but it's wrong. It's not reliable information, even though your equations is still balancing. Make sense? And I'm gonna show you just one time. Okay, I'm not gonna do this again and again. I want you to learn this, understand this, write it down, take a picture, because we are constantly gonna refer to these scenarios, and you need to understand why it's understated. The moment you don't understand, write this down on the paper, and you will see how it will be affecting. Sometimes liability will be understated. Sometimes asset will be understated. Sometimes net income will be understated. Sometimes expense will be overstated. If expense is overstated, then your net income is understated. If your revenue is understated, then your net income is understated. But if expense is overstated, then net income is understated. If expense is understated, then net income is overstated. If net income is overstated, that means revenue is overstated. So you have to understand in this equation, what will be understated or overstated, and because of that, what would happen. Make sense? But I want you to take a picture of this. Write it down, because we're going to talk about this over and over and over again. Did you take a picture? Let's move on. So that was number 3. Let's go to number 4. Your firm holds $15,000, 8% note receivable, issued on August 1st of 2020. Okay. Interest is paid once a year on July 31st at the end of 12 months. On July 31st of 2000, let's say 26, you received the normal interest payment. Okay, so at the end of, let's say 2016. On July 31st of 2016, you received the normal interest payment. So far, so good up to July 31st of 2016. What adjusting entry must you record on December 31st of 2016? So August 2016, September, October, November, December. I'm using and counting using my fingers, so I don't want to make a mistake. So make sure you count using fingers. Don't worry about it if you look like kindergarten. That's fine. So August, September, October, November, December. That's 5 months that you earned the interest, right? And you need to recognize that. So $15,000 times 8%, that's $1,200 annual interest rate. Times 5 out of 12, that's $500. 1,200 divided by 12 months, that's $100. $100 times 5 months, that's $500. So by end of December 31st, you have to recognize interest receivable of $500, that's a debit, and interest revenue of $500, that's a credit. Interest receivable is an asset, goes up, and revenue will go up also. Let's say in 2017, July 31st, you received the interest check, which is good. So you debit your cash for $1,200, and you close the receivable of $500, and also you record the interest revenue for the 7 months from January through July. So that will be your journal entry when you get a check for $1,200 to close the receivable and recognize 7 months of revenue. Any question up to here before we continue? B, if this entry is not recorded, how will it affect your company's financial statements? So if you don't recognize this adjusting journal entry, your asset, interest receivable, will be understated. If the asset is understated, then your revenue will be also understated. So if your revenue is understated, that means your net income will be understated in the income statement. And if the net income is understated, that means the retained earning in the balance sheet will be understated. So in the balance sheet, asset is understated, revenue is understated, that means retained earning will be understated. So your equation is still equal, but it's wrong. Make sense? Okay. Number 5, and last one. Your company, which has a fiscal year ending October 31st, sells sentenced bars of soap for 12% commission. As of October 31st, total sales are $400,000. Your company has received $30,000, which you credited to revenue. So how much additional revenue must you record for the fiscal year? So 400,000 times 12% is $48,000 of revenue earned. That's what you need to recognize. $30,000 is already received, right? Which is good. So you debit cash, 30,000, credit accounts receivable. But $18,000 still is not. So you have to recognize that at the end of the year, the things that is left over. So commission receivable or accounts receivable, debit, $18,000, and revenue, credit, $18,000. If you don't do this, then your asset will be understated in your balance sheet. If you don't do this, then your revenue will be understated in the income statement. If revenue is understated, that means net income is understated in the income statement. That means your retained earning will be also understated in the balance sheet. So eventually your asset will be understated in the balance sheet, and your retained earning will be also understated in the balance sheet.